Same with me. If someone told me, tomorrow discretionary trading is, way better for me, I wouldn't switch because I know I've been consistent with systematic trading. So if it is working for you and it is continue to work for you, then stick with it. I think there's nothing wrong with that. So many people assume when they see a strategy, hey, if it produces me 50% return, I could put X amount of money on it and I'm still going to get 50% return. Most of the time, that is just incredibly not true.
Hello, and welcome to The Trader's Journey by Investors Underground. In this episode, I speak with a trader, coder, and entrepreneur who helps fellow traders transform their ideas into systems and algorithms. Traders might recognize him from X/Twitter as Goshawk Trades. It's my pleasure to introduce Mounir. Hello, Mounir. Thank you for being here and taking the time to speak with me today.
Thank you so much for having me on. It's an absolute pleasure. I've loved many of your podcasts previously, so it's a dream come true to be on.
Thank you for the kind words. If it's okay with you, Mounir, I would like to ask and dig into a little bit of how your trading career and your journey began. So, as an opening question, how did you first get interested in the stock market and trading?
I think primarily it started when I was younger. I was interested in pretty much any high paying job. And obviously, when you do the classic kind of Google search, most of the time it says like hedge funds, becoming a trader, things like that. So that was my primary gateway to get into it. Ever since I was young, I did like a variety of very simple strategies. So when I was way younger, I did about like a dividend strategy. It was on like 200 pounds of capital. I was using my parents' kind of brokerage. And that made me a couple pounds here and there, which was good for some snacks or things like that. But that was the primary gateway in getting me interested. And then over that time, I kind of discovered more of the classic day trading community. So like Humble Trader, you guys, other people as well. And that kind of kept me going until I got deeper into trading. And now I've been trading for about five years and a half, give or take.
So, were maybe income or sort of a longer term career some of the things that inspired you to learn about trading?
Yeah, 100%. I think primarily I've always wanted to build as much income as possible, mainly just because, at least in my family, no one was a huge high income earner. So it was always kind of an ambition of mine to be able to earn as much as possible. So I was going to go down the traditional routes of, either becoming a software engineer, institutional trader, things like that. They have very high kind of salary, at least, entering and higher. And you didn't have to do anything as crazy as like a 6-year law degree or anything like that. Personally, I could never do a law degree. I have a sister that does one. It was about 6 years, a lot of reading, a lot of work. So I kind of took the shortcut of trying to go down the trading route.
Interesting and equally exciting, the career path that you both chose. In learning about trading and even coding, what resources were the most important or valuable and meaningful to you?
I think when I was first getting started, I have to say Twitter was a huge one. Obviously, I think I started a lot of my journey with YouTube videos and kind of online resources like that, classic kind of video content. But I probably found the most gold via Twitter users sharing kind of their own experience trading, their own strategies, things like that. And that introduced me into data, like after a year or two into trading, just by finding specific traders that were using data and sharing about it online. And that was able to expose me to the idea of, oh, I could probably do the same. I'd also say another one that's been a huge help is one-on-one calls. This is probably a bit later into my journey, but having a one-on-one call with someone further ahead of you, the amount of nuance they can give you for your particular like condition or part of your journey is just hugely valuable. I've also taken courses and things like that as well. But I think most of the time, a lot of the key aha moments were from someone ahead of me saying, hey, you should probably be doing this. And for me, it either never clicked or I never really listened before. Like I may have heard it on a podcast or things like that. But when someone directly tells you to do something, it makes you more motivated to actually, go ahead with that kind of progress.
Yeah, and data and working with successful traders are definitely some topics that I want to explore. Just curious about maybe one or two of the big takeaways that you've been told about by successful traders that you've worked with. What are some of those things?
For the one-on-one calls, the biggest thing was it sounds really simple, but I wasn't taking trading serious enough. I was more treating it as a side hobby rather than a proper career and putting in enough time into it. I was kind of all over the place of what I was actually focusing on. Like not so much in like different opportunities, but more I was very scattered in my own trading. Sometimes I was trying to do discretionary trading. Sometimes I was trying to do scalping, things like that. I never was fully focused on one part that would probably be the strongest strength of mine. And once I recognized it was data, it took me a bit of time to fully double down on that and focus on that strength, as that's going to be the way that I'm going to progress in trading. And I think for everyone, that's different. Some people are really naturally gifted at reading markets, and that's the thing you should be doubling down on. Whereas other people like me, I prefer the data side of it. I really lacked conviction when I was trading discretionary. So doubling down on data and understanding that more was the thing that probably got me the head furthest. For a lesson I've learned from working with traders, I think realistically, I've been most surprised by the people that have the most discretionary experience in their time. So maybe people that have been trading for 10 plus years, how much of a benefit it can be to have extra data with them. The reason for that is because I think when I initially worked with some of those people, I was expecting realistically, what are you going to get out from working with me? You've already got 10 years of experience. You're super successful. What kind of part are you looking to improve on? And a lot of the time is that they had so many ideas over that 10 years, but they didn't have enough time to actually test all of those ideas. After a 10-year career in trading, you may have hundreds of ideas you want to exploit, look at, see if they actually remain true. And those were things we mainly focused on. So definitely the benefit of data to people that are maybe further ahead, lots of discretionary experience, were probably the key ones.
Okay, thank you. I think that's actually really valuable advice, is just how seriously you're taking your own trading. Or do you treat it like a side hobby and you think you're taking it really seriously, but in comparison, how much work are you really putting in? Is it as much work as you'd be putting in if you started your own, brick and mortar retail type of shop, or are you just coming to the market half prepared, not so worried about your risk management, for example? So yeah, I think that's a very powerful answer. Thank you for sharing that. And one question that I wanted to ask, about your trading journey is, what were those first trades like, or even maybe that first year of trading like for you? What do you remember about it that time, now that you're looking back and can do a better job assessing that performance?
Think when I remember back onto my first trades, pretty much all I remember was the amount of emotion going on during that time. I remember fully being adrenaline hooked for a day taking my first couple trades. I think pretty much anyone that gets into trading, their first couple of weeks, even maybe a year, is a lot of adrenaline. You get very excited when you're taking a trade. You get excited about the possibility of making X amount of money on that trade or whatever you want to do. So I think those are the key things I remember, and I think it's obviously very symbolic of seeing the progress of that. Nowadays, I most of the time find trading actually quite boring. I more have tried to find excitement in like the strategy modeling side of things, building strategies. That's more what I try and find exciting about it. As most of the time, if you find your own trading exciting, that's probably not a good sign. Realistically, most of the time, it should be so. Maybe it doesn't have to be so systematic, but it should be so readily available to you to know what you should be doing, what you should be looking at, what you should be trading, what you should be doing. Is kind of the key thing. So that's probably the key mistake I made in my early years, is letting that emotion control me way too much. I will say, as one kind of side point of that, is I don't think there is any way of getting around that first year of mistakes and being way too hooked on emotions and things like that. It's really easy to say, hey, have discipline, and that's how you're going to fix your trading. But most of the time, that comes from many little steps, or many different aha moments during that time to actually get to what is called like discipline, or making you focused on a natural strategy. Discipline, I personally, now if I hear someone say, hey, you need more discipline, like I kind of hate it, just because it's a word that symbolizes so much more work that goes into your trading to actually have discipline. You don't just wake up and you're just like, oh, I'm ready to stick to my strategy today. It's doing that for a year, 252 days a year. That's what makes that actually hard.
Yeah, that's a great point. And as your journey progressed, at what point did data enter the picture? And at what point did you realize data is going to be, for you at least, very powerful to your ability to trade and to do it well?
So I was first introduced to data via two people on Twitter. It was mainly Day Trading Zoo and Short Baggy. I don't know if he's still around, but he was at the time. And that was in think late slash mid 2020. So when the market was going crazy, I was still losing money and hearing about all these people making tons of money. And then I randomly saw one of their tweets one day, and that kind of introduced me into the idea that, oh, I could be, why am I doing discretionary? I could be doing data and kind of looking at historical data to make my decisions. I will say that came sort of natural to me after I discovered that, simply because I think I've always had sort of a, not necessarily like maths background, but just numbers background. I wanted to do accounting. I wanted to do like I did economics and things like that, which made me a bit more suited to it. And that allowed me to quickly notice, hey, this is probably the direction I want to be going down. Once I identified that, I think the key things that I did to apply it to my own trading was quantifying every one of my strategies. Luckily, I will say, the first strategies I was trading at the time was small cap gappers. So, pretty much anything that's above 50% gap, shorting it around the open or whatever kind of discretionary element you want to add to it. And that's kind of what I was doing at the time. Luckily, that's very easy to systemize. You can just pull, historical gappers, see above X percentage, what is like the close red percentage, or what is the end outcome you're looking for. And then you can analyze different parts of that data to see how you would enter, how you would optimize that strategy and things like that. And then via that journey and via tons of other resources, I learned more about, different ways of backtesting, some ways of robustness testing and things like that.
How did you learn about the ability to backtest? Were you taking courses in backtesting or anything like that? Or did you just sort of piece things together over time? What did the beginning of that backtesting sort of epiphany look like for you?
In preparation actually for this podcast, I was really thinking about that sort of question. Like what was the journey that got me here? And to be honest, I think the most accurate is piecing small things together over time. It was very rare that I had an occasion where I would take a course or something and it would dramatically accelerate my journey. It would be more that I took something, I discovered one technique, and I was like, oh, okay, that's really interesting. Let me start trying to test that. And then, normally it takes a month or 2 months of testing it, trying different things to really understand that technique or whatever you're doing. And then you keep on going from there and there and there. And then over time, over a year, 2 years, you progress a lot further than you would have thought. So I think, at least for direct resources, definitely taking some, mainly buying some books, really. The key kind of books that were really interesting in the beginning for me were like Ernest Chan books, Timothy Masters books, evidence-based technical analysis. Those sort of books were really great at giving me a flowchart in some essence of what I should be doing. Personally, the evidence-based technical analysis book, while it's still flawed in some ways, it gives you a really good breakdown of how he's looking at a particular idea, quantifying it, and then kind of backtesting it and what he's looking at in those results, which is great. Like if you're new to backtesting and being a bit more systematic, that is gonna skip months and months of work for you to discover all those things, and you can just find it in one book. I will say though, many traders, especially myself, I was never thinking I was going to learn trading via a book. I don't think it's like the classic thing of what people think nowadays. They more think video courses, things like that. But books can really be great, and most of the time they're sort of affordable. Some of them can be more expensive, but for key resource, definitely books.
Okay, thank you. And were you doing work and analysis at that time in sort of maybe a spreadsheet, or were there other tools, online tools maybe, or anything like that, that you were using to sort of record your data, track it, review it, analyze it? What sort of tools were you using?
In the beginning, it was mainly Excel. I previously used a lot of Excel because of accounting, so I knew my way around it, so it was quite easy to get started. I think also most of the time, I think one of the first rooms I joined was a Humble Traders room, and she made you track your trades via Excel as well, so I was kind of used to that sort of dynamic. So yeah, a lot of the time it was me looking at the gaps on the day, noting down the ticker symbol, noting down whatever data points I'm interested in, and kind of building that up slowly. And then primarily what made me focus onto using code was, I remember, I think it was after 3 months of tracking data, I had tracked maybe a year in total, because I'd looked back on some historical charts as well. And I realized I really hadn't made that much progress. I was primarily just entering things into a spreadsheet, and I never really took time to look back on them, analyze them, get conclusions from them, or whatever I want to take away from my own trading. And that was it was a tough time for me, just because I thought that I'd wasted 3 months tracking every night, for like 2 to 3 hours. But realistically, it pushed me towards going, hey, okay, like I already know some code. Why am I not using code to kind of do this? And I think sometimes you have to hit that kind of breaking point where your brain finally goes, okay, like let's search for different solutions. And it was really easy. Like once I finally discovered, hey, I should really be using code. I looked up some data providers. So currently I use Polygon and FMP, which is Financial Modeling Prop. And those are great resources, or I guess APIs to pull data from if you're going to use code. So I started already using some of my coding knowledge from before, started pulling code, and by end of weekend, I probably had around 5 years of historical data that I could actually analyze. And because I hadn't spent 3 months trying to track that data, I actually had the energy and time and mental bandwidth to look over that data and find some conclusions that I wanted to take away from them. And I think that's normally the biggest thing about manual tracking is so boring and also tiring to do by yourself. It kind of takes time away from what you should actually be doing, which is the analysis side of things. Like having data in a spreadsheet is useless if you don't actually use it.
Yeah, that's very enlightening. You were digging deeper instead of trying to just accumulate more knowledge at a certain point, it sounds like. Is that accurate?
Yeah, I would say so. I think it was mainly that like I just realized I was doing something of a task that seemed productive in the point of time. It seemed very productive to say, hey, I'm tracking data, I'm spending 2 hours every day, noting everything down. But I think Lance says something similar to like, you actually need to take action on whatever you're tracking or whatever you're looking at, even if it's just your trades. Like spending time to actually analyze them and go through them is the thing that's actually going to improve your trading, not the actual action of just tracking your trades or whatever you're tracking.
Was there a particular moment where you sort of were reflecting or realized, okay, I'm actually onto something here. This could work for me. This is something I feel confident in doing now. Uh, in that part of your journey when you were learning how to backtest and go over the data.
I think the easiest example was probably after I'd pulled that like 5 years of historical data on small caps. I quickly realized like the key thing I'm looking for on a small caps gapper is you're wanting it to close red. Most of the time, you're trying to hold it until end of day if you're being systematic about it, or you're looking at least for a decent percentage. Decrease from the open price because that's you're probably shorting it above the open price or at open, and the quickest statistics I saw was that hey, 70% or so of gappers do normally close red, which is a huge deal. That's like a huge conviction point where you can be way more confident in your actual shorting of these particular tickers. And then that led me to the next question of okay, why am I suffering so badly then? If it's supposed to be 70%, shouldn't I be winning 70% of the time? Like like what am I doing wrong? And then the key thing that makes you look into that is then most of the time the 30% that isn't closing red, they're having very volatile extensions. So those extensions are normally extensions you can't outlast, whether that be via emotional control or just being amount of capital that you're down if it extends over 20% and your risk management and things like that. So then that made me adapt and change my model of how I was actually shorting these and how I was going around risk and everything like that. And I think Ernest Chan has a really good part of it is like you'll learn a lot from the data itself, but then when you actually put that into application, you'll learn your next amount of new ideas and new improvements you can actually do. Because once you have that kind of risk actually on the table, there'll be a lot of more things you notice. And that's why like personally, at least for me, I still do some manual trading with my own small cap gappers. The main reason behind that is if you only look at data like 100% of the time, it's very hard sometimes to actually get those original or unique ideas of what's causing you issues and why that's actually not creating a great strategy for yourself. So having that risk on the table and actually implementing those strategies as quickly as possible and testing can really create that kind of snowball of progress.
Are the same types of data that you use now the same types and hold the same amount of importance as the ones that you did and used at the very beginning? Or has that sort of changed over time, how you use specific pieces of data?
Good question. I think for the most part, it's stayed sort of the same. I think the key difference in that question is that I've primarily moved to doing fully automated execution in futures. So obviously that's no longer really focusing as much on small cap gappers. There's a couple of reasons for that. I'll give you a brief overview of them. Mainly, it's that small cap gappers, you have a lot of volatility risk and you have a lot of risk you can't control in the sense of halts, things like that, liquidity dry ups. Those are really big risks. So once you try and start to continually scale that, those become very dangerous risks if you're going to keep on scaling, and you have to be very nimble to be able to get around those. Whereas in futures, you realistically don't have that much of a liquidity dry up. You have to size quite big to have that happen. And additionally, the market's open further and it's also easier to automate on that market. So that kind of led me to, hey, I like doing systematic approaches. I wish I could actually take myself out of the execution because even I still do my small cap gappers execution now, I'm definitely not a good trader by execution standpoints. I'm decently disciplined at it, but I still would say I'm a pretty weak executionist compared to just creating the actual model itself. So that was just niching down on my strength even more and focusing, hey, I should probably just go into more automated. But then, as I said before, I still keep that manual execution so I can keep unique ideas, still be actually trading daily, and kind of keep that going.
You brought up trading systems, so I wanted to talk about that a little bit as well. How would you even define or explain what a trading system is?
Sure. I think like the algo word makes it sound super complicated, but realistically, it's just predefined rules. So if you can make some rules in like an Excel formula, that can be pretty much translated over into code as well. As long as you're not falling for any bias or anything like that. For the most part, a system is just anything that can be traded upon based on a certain criteria. And those criteria are normally like if and or criteria. So if price is above X point, we're shorting and we're closing once it closes below SMA, for example, as a very easy example.
Is there ever really sort of a fully automated system, or what would that roadmap look like to take someone's maybe their idea and how they trade discretionarily and move that into possibly a system that's automated or partially automated, and if it can ever be fully automated and executed, what does sort of that time frame look like?
Sure. I'll go for the first question first, just because I think it's the easiest to one, and then we can go into the second. But primarily, can a strategy ever be fully systematic? I would say the actual strategy itself can be definitely fully systematic. The rebalancing of it, well, I guess that's if it's a portfolio strategy. For just simple examples, let's just say it's like an SMA strategy that can be fully automated with execution, risk management, closing trades at end of day. All those sort of things can be automated. The part to that is I don't think trading can ever be fully automated in essence from idea to execution. The reason being that is even if you use some advanced techniques like data mining, which is pretty much just getting historical data and applying a machine learning algorithm over it to discover inefficiencies or a particular strategy over it, depending on what you're looking for. Even with that, you are picking what data to give that particular machine learning algorithm, which means pretty much any part of trading in the strategy development is going to be discretionary up until the point where you're defining that actual system. So you will always need discretionary parts of things in trading, but the actual strategy itself, the actual execution, yeah, that can be fully systematic.
If you're looking for ways to take your trading to the next level, Investors Underground might have something to offer. You'll have access to courses and mentors to learn from, some of the best technology available for scanning stocks and breaking news, and access to the chat rooms, where you'll find a vibrant community of focused traders who share their trade ideas in real time each day. Members also have access to the morning broadcasts, where moderators and members of the community share their trade ideas for the day ahead during the pre-market session. Members have access to the midday discussions with Stan, the midweek study sessions with Sam, webinars, moderator watch lists, and all the other resources that Investors Underground has to offer. Listeners of the Trader's Journey can access exclusive membership deals available at investorsunderground.com/journey. And now, back to our episode with Goshawk Trades. What does the process and timeline look like from the moment a trader might want to start thinking about backtesting to the moment that you analyze it, code up what you think might be the right way to implement it, and then to go into the point where you're interested in maybe letting it go live with that particular coded strategy? What does that all look like?
Sure. So obviously first you have the idea. So you want to quantify the idea as we mentioned before, having an if and or like an Excel formula. And then from there you want to collect some historical data. So if we're going on to the assumption that you have either a coder or you can code, you'll probably want to pull 5 to 10 years of historical data. Now that isn't always needed. The biggest clue of how much data you really need is how many trades your actual strategy is taking. So if you've been manually trading that strategy and hey, it's taking about 10 trades per day, then that's quite a lot of trades. So you probably won't need as much data. You'll still want a decent amount of data in sense of that you have across different market regimes. So bullish, bearish, choppy. Those things are great for robustness. So if you can see how the strategy reacts to those different market types, then that's really useful. Once you've got that data, you then obviously want to code up the strategy or just analyze analyze how it performs over that historical data. Once you have that, you'll want to look at the obviously performance metrics. So you want to look at win rate, Sharpie ratio, drawdowns, return, annual return, all kind of metrics like that. Those metrics then can allow you to evaluate if you want to, continue looking at the strategy further. Probably after, if you've got a decent strategy performance, you'll want to look at robustness testing as well. So robustness testing, the goal of it is really just looking how reliable is the strategy going to be on live market data. So with the best of our knowledge, how well do we think it will perform? That's normally broken down into 3 techniques. So you normally have Monte Carlo. Monte Carlo is really simple. Just think of it as the trade sequencing of your backtest. When you actually take that live, that sequencing could happen in any order. Because trading is a random distribution, which means trades are never, fully predicted to be in the next trade. You never know what trade's coming next. You need to test for that in your backtest. So you want to make sure basically, is this a lucky backtest? Did I just have the lucky trade sequencing and that's why it's really profitable? Or is it still profitable if I reshuffle that sequencing? Next, you'd want to probably look at either out of sample or walk forward optimization. They do pretty much a similar thing. What out of sample means is just data you haven't optimized over. So let's say you had 2015 to 2020 data. Let's say you had tested the strategy historically from 2015 to 2020. You'll then want to see how did that parameter optimization during that time perform on 2020 to 2024, for example. And if it performed really well, then that's a really good sign. You can see that even though you haven't optimized over that time, it's still performing well. It's maybe slightly underperforming compared to the optimization, but that's completely standard. You shouldn't be too worried about that. And then the second method of that is walk forward optimization. What that is using out of sample data and in sample data, but on a cycling basis. So you'd have in sample first, let's say 2 months of data. You optimize over that 2 months, then you test it on out of sample for 2 months, and then you kind of repeat that process. And then lastly, you probably want to look at parameter sensitivity, which is all in purposes, you're just looking to see if you had a lucky parameter. So if I said to you, I'm using the SMA 64.5, most traders would find that a bit weird. Like that's a very unique number. Why are you using that particular SMA? And most of the time, if you've tested over that historical data and for whatever reason, 64.5 is equaled, 100x returns, that's probably a lucky parameter. And the way to test for that is just try 63, try 65. Is the performance consistent? Are you having a gradually sloping performance, or is it a huge spike where at 64.5 it's amazing and then you change it to 64 and it's terrible? If so, then that's a clear sign that that strategy probably won't work on live markets. Obviously, you can still test it. This was a thing I talked about recently where if you spent all this time backtesting a strategy, still at least attempt to put it on a forward test, which is just testing on live market data. If you spent all this time, at least give it a go. But doesn't mean you need to put any risk on it. You should just put it in a sim account, see if it works. And if it does, then great. You can, continue using that strategy. Maybe your testing previously was flawed, or maybe it's just a lucky strategy in essence. But you still want to at least test on live markets. I think that pretty much goes for everything. If you have any questions on that, then you can feel free
No,
to
I think
ask.
that's fantastic to get that much insight on what the backtesting looks like. I think there's a lot of traders who might not know just how much data, for example, that you might want to even have to begin with. And on that note, correct me if I'm wrong, but just to clarify, it sounds like you would like to have as much data as possible to compare against, and you'll want to do a fair amount of work to maybe test the validity of different potential variables. For example, like you were talking about with, a moving average, for example, might give you, with so much data available, it might give you a completely different type of insight if you compare it, to maybe just a small adjustment. Is that about accurate? As much data as possible and really thoroughly analyze its effect on the way that you're testing. Sounds very scientific. Is all that about right?
Yeah, for the most part, I think for anyone that wants to be really nerdy about this topic, there is a whole conversation on that. Ideally, in the best worlds for strategy modeling, you would have the most data. You would have unlimited data, because at the end of the day, you always want to be able to do in sample data, which is optimizing data, and then you want to do out of sample. So ideally, you'd want unlimited data that has very similar characteristics. But unluckily, in the real world, 2012 data compared to 2020 is night and day. Like they're not very similar in any way. So that makes strategy testing a lot more difficult. Necessarily, if something worked in 2012, that doesn't really mean it'll work in 2020. Just because 2020, as we know, was a kind of an outlier market. There's way more volume. There still is way more volume compared to previous markets. So realistically, you want as much data as possible to test over, but there is still a bit of a recency focus that if it's continued to work for the past year or two, then that's a really good sign. If it was working amazingly from 2012 and then stopped working at 2021, then that's kind of a bad sign for me. I wouldn't really want to be trading that, even though it's done such a good time between 2012 and 2021. You still want to see it working continuously, kind of recently.
Did you ever go through these periods where you'll omit certain market cycles out of the backtest, or is it always recommended, would you say, to, you know, take as much data as possible, and if a certain strategy is just not working in a particular time frame, you maybe just call that an outlier and kind of just go about the testing? How do you think about that and the different market cycles?
Sure, it's a really good question. I don't think I have the perfect answer for it, but at least how I view it. So let's say we have a strategy that's a trend following strategy. It was working really well in 2017 to 2019, and then it went exponentially well, like the returns 10x in 2020 and those kind of years following. That for some people would look like it's maybe overfitted because in 2020 you're having an outlier market and you're performing really well. To me personally, the strategy was already performing well before, and because the market condition was even more right, it's just performed even better. So to me, that's actually a good sign. If it can perform on a less ideal market type, and then it can perform amazingly on an ideal market type, then that's a really good sign. I personally wouldn't ever omit market cycles, mainly because market cycles do come and go, and depending on how long you're going to be trading the strategy, you do want to see how it would react. So we never know if another 2020 is going to come around, but I want to see how it's going to react to that. And there's even a whole technique where you test the strategy over like financial crisis. So let's say you test a strategy in 2008, see would you blow up in 2008 if something like that happened? And that's a really interesting thing to know because you want to know, is the strategy robust enough to, or well, like you've got good enough risk management on that particular strategy to survive those kind of events. Most of the time, all of us think those kind of events, they don't happen that much, but at least historically, they happen pretty much every 2 years, give or take. So if you're trading for the long term, you're going to be trading over the next 10 years, you're probably going to at least encounter a couple of them. And with recent years, there's been way more. So you want to make sure that your strategy is robust enough and you want to know how it will actually react to those events and not blow up your capital.
Do you believe that all traders should have or be working to create a formal system for their trading? In other words, what are your thoughts? What would you say to the trader that just kind of shrugs it off and says, "Oh, I use my intuition and I use my gut feeling, sort of to predict what is a good trade and what I should use in my system"? How do you kind of compare the two between discretionary and building a trading system?
Sure, yeah. I think some traders are very defensive of their own approach, and they think no one else's approach really works. For me personally, like if you're really good at discretionary trading, then go for it. If that's your strength and you're really good at it and you can do consistent performance, then why would you change? Same with me. If someone told me tomorrow discretionary trading is way better for me, I wouldn't switch because I know I've been consistent with systematic trading. So if it is working for you and it is continue to work for you, then stick with it. I think there's nothing wrong with that. I do say that most traders could benefit from some data. We've worked with traders that aren't fully systematic and they have that kind of hybrid approach. So they have a particular strategy idea they want to look at, and we kind of systemize or at least backtest the simple idea of that strategy. Easy example of this is, let's say we have gappers, just because small caps are so easy to quote upon. You're looking at gappers and you're going to do a certain short play. Let's say it's based on extension from the open. We can see how profitable that is historically, but the actual trader itself is going to implement their own knowledge of like time and sales, for example. We can't really quantify that very well, but if they're really good and they've been doing times of sales for 3 years, that's going to only add to their kind of edge during that trading strategy. So yeah, if you're good at it, go for it. If you want to add some data, go for it. I think any way in trading really can work for the most part.
At what point do you become confident enough in implementing or codifying a system that you're ready to roll it out and go live with it? What does that process look like? Do you go live with maybe 20% of the account size and sort of scale it up until you maybe get results that you're confident with to go full size? What does that part look like?
Yeah, sure. So if you've analyzed your back test and you've analyzed all the other tests and you're seeming like it's good to go for testing it live, then you just normally want to do at least a sim account first on Live Capital. Main reason for this is realistically, if it's a really overfitted strategy, you'll discover it within the first like 2 weeks to a month. If that strategy is consistently does not perform during that time, then you probably know you've overfitted that backtest, and that saved you some live capital. If it looks decently okay, or the balance here is like, let's say it's in a drawdown, but it's not an incredibly extended drawdown and it's still sort of maintaining some of its performance metrics, then that's still a good sign. It's just in a drawdown and every strategy has a drawdown, so you just kind of have to be okay with that. Then you could then take it to live capital. The key, at least for me, when I go onto live capital, is you do want to do a slow scaling process. The reason for this is if you let's say you have a really big account. Let's say you have like $1 million you're going to be trading with. If you put $1 million straight onto a strategy straight away after that testing, you have no idea how that's going to create market impact, which is just the slippage based on what you're trading with the volume, and you have no idea how that's going to affect the actual performance because of that slippage. So you ideally want to slowly scale that up, and seeing when and if there's any impact on the actual market itself based on slippage, commission cost, or anything like that you maybe haven't properly tested for. And that's going to be really important because if you, I think really anything in trading, going anything blindly into trading is always a bad idea. There's just so many unknowns. So slowly scaling into it is normally the best approach.
And would you say there are any limitations to scaling up a strategy? For example, do you think certain types of strategies or styles edge that traders find in their system become too big maybe at some point? Basically, could you theoretically scale up infinitely, or is there sort of limitations to what you can do?
I would say this is a really good question because so many people assume when they see a strategy, hey, if it produces me 50% return, I could put X amount of money on it and I'm still going to get 50% return. Most of the time, that is just incredibly not true. Key thing is depending on your market, liquidity is obviously going to be the biggest constraint. So as you add more liquidity onto your trades, that is going to cause more slippage, and you may have actual market impact where prices move away from you, meaning your execution price is actually the least favorable possible, which is a really big issue. And that's why hedge funds and big institutions focus so much time on their execution engine. When you're trying to execute an order for, let's say, a billion or whatever, that takes incredible complexity and operational risk to be able to actually do that in a correct manner. So most of the time, most retail capital, unless you're getting past, well, it still really depends on the actual market itself. I was going to give you a number, but realistically, if you're trading OTCs, that liquidity constraint is going to be so much different to trading like SPY, for example. They're very night and day. The other part, obviously, like I guess as side points, is you obviously have regulatory constraints. So if you take X amount of float, then obviously you're going to have to file things and things like that. That adds more risk and operational side of it. And then lastly, the actual complexity to be able to pyramid orders in a good way to actually still get a favorable price when you're trading that much size is probably the most difficult part. There's a lot of people trying to do that, and it's a very difficult thing to achieve properly. And then lastly, if you're trading even more size, most likely competitors are going to notice. If you're trading that much size and you're profiting that much, it's going to get noticed at some point, and that may just kind of completely ruin the edge. So most strategies, I would say, you can achieve high returns that sound unreasonable when you're on low capital, but as you scale that, that is going to rapidly decrease in the amount you're going to actually position off. Like even with Jim Simons, he was able to do an amazing track record, but even he limited the amount of size his actual fund took in because he knew after that kind of X amount of size, it wasn't going to work as well. So if someone as smart as him kind of equates for this, nothing really is infinitely scalable.
Thank you. I think that's a fantastic way to think about maybe the limitations of a system. I wanted to also talk about the work that you do with traders to codify their systems. So, what inspired you to start working with traders in that capacity? Basically to implement the things that we've been talking about, away from simply just maybe an academic way to think about things to actually doing the work. How did that all start for you?
Originally, it started really as a way to get in front of the people that I wanted to talk to. Most of the time, if anyone's trying to network and things like that, being able to offer some value upfront to people, especially when it's targeted value, is probably the easiest way to get in front of them. So a lot of the times I knew some of the best traders weren't maybe knowledgeable in coding, or they weren't able to get X amount of data or anything like that. So I would just, hit them with a DM and say, hey, if you're looking for this kind of data, I've already have it for you. Just let me know and I can send it over and things like that. And that got me in front of people more and more. And then over that time, the requests became a bit too much. So I started charging for that X amount of time or whoever wanted to work with me. And that kind of, I guess, brings me to the second point, is that obviously I do unbiased trading to build my own capital even further. It's a great way that I can provide value to someone else for something they need. And obviously I can get that kind of value back in return. And that's obviously just a two-way street on that. Lastly, I will say this more plays to the Twitter side of things. The reason why I do threads so much and things like that often is I feel incredibly lucky, realistically, that I was able to see Day Trading Zoo's tweet one day and short baggies and other people's tweets to be able to get this far. If I had never seen those tweets, I can't say with certainty that I would be at this level or be able to know this information. So I want to give that back and, expose other people to the ways I approach trading. If they don't like that approach, then that's totally fine, but at least gives people a different way to look at it. And then lastly, I just enjoy solving problems at end of day. So people come with some really interesting projects, and those are, really awesome to work on because they make me think it's a good kind of side thing to do. And that never really gets boring.
And I wanted to touch on that a little bit more. So, like, what type of strategies, we definitely don't need names, but, what type of strategies, or maybe one strategy that stands out to you, is a good example of your ability to take something and to codify it?
It's a really good question. For the most part, just so I don't reveal anyone's strategies, I'll just give you a simple and like a complex version of my own ideas. So obviously, like a simple one, we know the classic saying that anything that goes up really fast will come down as fast. So we want to test that particular idea. That idea is really simple to quantify. We're just looking for if something moves X percentage or even ATR. ATR is just average true range, which is like a volatility metric. If it moves X amount of that, then we're going over X amount of time. So if it, let's say 10% in 10 minutes, we're going to then categorize that as a fast mover. And then we want to enter on that trigger. That way we can see quickly and backtest that. How does that do? Then you can even add more filtering. So let's say we want to make sure that it's, losing value as it's going up. So we could say it moves 10% in 10 minutes, but then it must break the low of the bar that actually triggered that alert. And that's a easier way for confirmation. And then we can test that idea and kind of go from there. A more complex one that personally still is, I've never really been able to solve. It's always been a part I think any person that gets into coding really wants to look at because there's so much data. But times and sales is one of the most difficult things really to do, at least in my experience. A lot of time people say, hey, like this looks like weak tape, this looks like heavy tape, and then you try to get them to define that. That often can be very hard for someone to correctly display what they're actually looking at or of how they're going to be looking at it. For me, at least what I tried was I looked at times and sales and I just measured the amount of large orders which were coming in above X amount of shares or X amount of contracts. Another way you can do that, which is personally my preferred method, is looking if it's above the median X amount of shares over that time. So let's say you're looking at like 30 minutes, you can see, hey, what is the median value for the amount of shares during that time? If it's above that, then we want to pay attention to those shares and see if they are hitting the bid or if they're hitting the ask, and that can help us determine what we think of the basically the times and sales at that current state. So those are just two ideas, one simple and one more complex.
Okay, great. Those are great to think about as well. And sort of on that note, what have you learned about the nature of systems themselves? Getting to work with different traders who might have different systems. Like, for example, a trader might say something like, oh, yeah, it's a pretty simple system, or it's a very simple system that I use. And then you try to code that. Maybe it's, I don't know, is it as simple as they ever say? Are trading systems, the nature of them, ever truly simple?
You're completely right. For the most part, I'd say 90% of the time, people do think their strategies are more simple than they actually are. I think the classic reason for this is probably you've been trading it for like a year maybe, or, X amount of months. And it becomes very simple, very mundane to you of how you look at that particular strategy. But when you actually get into quantifying and how you're looking at that, a really easy example is people will often say, oh, I'm looking at this particular trend line and I'm looking for it to break below that trend line. On surface level, that sounds very simple. You're just looking at a trend line, you're looking at it on a chart, and you're looking for it to break below. When you go deeper into it, how are you actually quantifying that trend line? Are you looking at a certain low to a certain high? Are you looking at a certain degree? What ones are good, what ones aren't good? And that takes a lot more time to actually kind of go through that process, understand it, what they're really looking for, and sometimes in rare occasions, you really can't quantify it. Or I'll put a caveat on that. You can't quantify it to the level of the discretionary experience. So it wouldn't make sense for them to quantify it because they're so good at it doing it discretionary. Maybe it wouldn't make sense to quantify it. The only reason you would ever want to quantify it really is if you're trying to make it fully automated so that you have more time to spend on other strategies and building a portfolio. Then yeah, it can make a lot of sense. But if you're just trading, let's say, two strategies or a strategy, then yeah, maybe just keep on trading discretionary as long as they have no like trade execution issues or anything like that. Then it makes more sense to stick to what you know and what you know you're good at with those kind of trend lines.
Okay, yeah. And do you ever come across cases like that with discretionary traders where there's sort of these, you have to really quantify things just due to the nature of coding itself? Because if you're trying to code something and there's a variable that you haven't thought about or the trader hasn't thought about, your backtest or your system, the code necessarily won't function. So do you come across those sort of holes in the discretionary trade where they haven't even thought about maybe X amount of percentage that they're looking for something to fall or to raise during a parabolic type of move where you literally need that number in order to have your code function?
So for the most part, we deal with it in variables. So as your example, like X percentage, that X is always going to be changeable. The reason for that is it's kind of like filling in a number into a formula. Let's say you wanted to do X plus X, you can always change those, and that doesn't really matter. It doesn't actually change the formula itself. But there have been times where we just haven't been able to fully quantify a strategy, and we haven't been able to take on that particular project, even with the current experience I have. And that plays into why the problem solving is a lot of fun, because sometimes to quantify these ideas, it does take X amount of hours or a day plus to really think through and understand how you'd go about it. So yeah, for the most part, it can happen sometimes, but I will say it depends on the pros and cons. Most of the time, for people that do find it beneficial to work with us, is you're looking to do something else with your time. Being able to execute a strategy at a high degree is very time consuming. So it's about that kind of delta between, is it being slightly less well performing because of we haven't been able to quantify this particular variable that you use, compared to, is it going to provide you more actual profits over time or back return on your time because you get to deploy other strategies or work on other things during your time. So it's kind of normally during that delta where people can determine, is it worth it, is it not worth it.
And have you come across any surprises after going through a system and codifying it? For example, the P&L, once you implement it, is surprisingly well or not doing so well?
I think two real surprises come to mind. One is consistently how simpler strategies do normally perform better. I know some people will hear that and they'll think every simple strategy works well. It's not so much that. It's just that it's very surprising when you have a strategy that has one indicator and like two parameters and it can still perform well. It feels very strange that you don't have to do something super complex to actually have an okay performing strategy. So that's probably number one. We recently did a strategy that was just simply one indicator, two parameters, and it performed very well. It performed very well from like 2012 to 2024. So that was very surprising. The other one was a story from a previous trader we worked with, and he had a coder who had made him an algo, and they had forgot to add redundancy. And this is why it's also very important to think about every aspect when you're coding something that's going to be fully automated. The part of the redundancy that they'd forgotten was they had put an equals condition for the stop level instead of an equals and above. The reason why that's an issue is, let's say you're in small caps and the price halts under your stop level. So the stop level hasn't been triggered yet, it's just halted. And then when it comes back, it's above that stop level. If you only had an equals condition, which basically just means, if your stop is 1.97, it only can exit at 1.97, then that's never going to be triggered. So they actually didn't realize that, and they had that position holding pretty much until end of day, and it was a significant loss for them. And it was from a very simple issue and a very simple error. But things like that can be surprising and scary. Like there's definitely, I think I had one person ask me recently was, is automated execution like safer? Is it less stressful? All those kind of things. And I think it's kind of the wrong question for traders because trading is just never like less stressful. Even if your execution is automated, you're going to be stressing. Oh my god, is this strategy going to keep on working? Are these profits going to continue? Am I going to continue in this drawdown? It's just never really like chill and calm. So whether you're going automated or discretionary, I think the only difference really is in automation, you're not focusing on the actual trades themselves. You're focusing on the strategy. So think of it as like viewing from above, like one extra time frame, compared to when you're actually discretionary trading. You're in the trenches. You're taking all those trades, and that stress is coming kind of from there. So it's just two different ways of looking at it, two different time frames of how fast you need to make decisions. And for me, I've always been able to make decisions better when I've had more time. I think that's why I suck at discretionary trading or just like reading markets is my quick thinking decisions are very poor. They're not very good. I normally need a solid couple of minutes or even an hour to properly think through something. And that's why automated execution was always easier for me compared to like discretionary trading.
Since you're able to implement code and work with traders, how else are you using your ability to code? Is it all just for backtesting, or are you doing anything else, any other ventures, things like that?
Yeah, so currently I manage the dev team at Ask Edgar. I coded a lot of Ask Edgar myself. So Ask Edgar was primarily AI to fundamental data, so like SEC filings, for example. We pretty much just realized it was founded by my friend who had previously worked with me, Jason, and he's incredibly talented at SEC filings. So we were thinking, how could we look at this in more of a structured way? So there's basically something called structured data. Most of the time, SEC filings and fundamental data isn't very structured, meaning it's just kind of, you have a whole paper and there's nothing really that you're looking at it specifically. And we wanted to change that and make it more approachable to be able to look at SEC filings, which to me personally, like I've been in small caps for, 4+ years or whatever. And I still, SEC filings are still a difficult thing to understand, fully understand all the form types, understand what it's saying. And obviously because it's in like a lawyer jargon, it's very difficult to find what things are actually going to change your trade and what things are going to be impactful. So we try and solve that problem really just using AI. So that's been the key thing I've been working on a lot recently, and that's been a lot of fun, a lot of new problems to solve, and it's growing quite well. So yeah, that's been very exciting.
Mounir, we're getting towards the end of this episode, so I'd love if we could maybe go through a lightning round, quick questions and pretty quick answers. Would that be okay?
Yeah, sure, let's get it.
My first question is, what would you consider to be your greatest strength as a trader?
Probably resilience.
Is there anything that you're working on currently to improve your trading?
Building out more strategies into my portfolio. Currently have about seven. I want to get that way higher.
If you could give yourself one piece of advice toward the beginning of your trading journey, what do you think that advice would be? And do you think you would have listened to it?
That's a really good question. Probably patience is going to take you further and faster than not having patience. And I probably wouldn't have listened to it. You only realize that with time, probably.
What is the origin of the name Goshawk Trades?
So Goshawk Trades Goshawk is a bird that I was very fascinated when I was younger.
What would you say are your top two or three favorite trading tools that you couldn't live without in the work that you do?
Number one, I have to support Ask Edgar. I built a lot of it, so that's a very favorite one of mine. Two would definitely be trade ideas. They're great for like a scanner for finding alerts, so they're awesome. And then lastly would be Ninja Trader. Ninja Trader is where I execute and backtest a lot of my futures algos, so I pretty much can't go without them.
For anybody listening who would love to learn more about you, the way you trade, the way that you backtest, or maybe even get in touch with you, how can they do so?
So you can check out my Twitter, which is Goshawk Trades. I pretty much do a thread every weekday on either topics I'm interested in or something I've learned over my journey. And you can also check out my website, which is unbiasedtrading.info. And that's where you can book a 30-minute consultation if you're interested in backtesting or automating your trading. Apart from that, I have a YouTube, which I do a video about once a week, give or take. And those are normally just more detailed videos on my Twitter threads, so you can find out some more information.
Mounir, thank you so much for taking the time to come on and share your trading journey with our audience. I had a lot of fun talking to you and sort of picking your brain about backtesting and the work that you do. I find it fascinating, and I think the audience will as well. So thank you so much, Mounir.
My absolute pleasure. Thank you so much for having me on. See you.
We hope you enjoyed this episode of The Trader's Journey. We have additional episodes we believe you might also like, so don't forget to subscribe. You'll be notified of upcoming episodes the moment they're published. Thanks for tuning in.